Welcome, curious minds, to the deep dive. Today we're embarking on a fascinating journey. It's into a topic that subtly, yet profoundly shapes our financial lives. We're talking about the intricate world where human psychology meets investing.
Exactly. We're going to explore how our inherent mental shortcuts, our emotions, even our biology, how they all influence our financial decisions, our wealth, and yeah, even the market's movements.
It's really about understanding that this whole pursuit of financial well-being, it isn't just about spreadsheets and numbers. It's deeply, surprisingly human.
And if you've ever thought, that financial decisions are purely logical, just a cold calculation, well, prepare to have that view broaden quite a bit. We'll show you that even the smartest professionals, the most sophisticated models, they just can't escape these predictable patterns of human, irrationality sometimes.
Let's unpack this with a really powerful example, something relatable. Think back to the financial crisis of 2008. Just remember that sheer, palpable panic.
Oh, yeah. Intent.
Governments were frantic, right? Literally force-feeding billions into banks, taking over giants like AIG. The whole system felt like it was on the brink.
The market reaction.
Exactly. The Dow Jones Industrial Average plummeted over 50% from its peak by March 2009. It was genuinely terrifying for anyone with investments.
And right in the middle of all that fear, what were individual investors doing?
Selling. Massively selling.
That's right. They collectively unloaded over $150 billion in stock mutual funds.
Yeah.
Right near the absolute market bottom. Now, here's the kicker, the paradox.
Go on.
These same investors had actually been net buyers. They bought $11 billion in stock funds the very month the market peaked. At its highest point.
It's truly mind-boggling when you put it like that, isn't it? Yeah. Intellectually, we all know the phrase, buy low, sell high. It's investing 101.
Yeah.
But the stark reality those numbers just scream it is that in those moments of extreme volatility, our actual behavior, it often completely contradicts that basic wisdom.
Emotions just take over, magnified.
And our actions can become, financially destructive. This isn't just a random quirk. It seems systematic.
And it absolutely extends beyond just individual investors. Even the pros, the financial professionals armed with all their fancy models and tools, they aren't immune. In fact, their over-reliance on these complex mathematical models can sometimes, ironically, lead to increased hidden risk-taking.
Making them vulnerable to those black swan events.
Precisely. Those rare, unpredictable shocks that can just blow up entire systems.
So our mission today for this deep dive is to really get into The Psychology of Investing by John R. Nofsinger. It's a remarkable book because it doesn't just talk about how people should behave rationally, like traditional finance often does.
Right. It's not about the ideal, rational economic man.
No. Instead, it meticulously studies how people actually behave in financial settings. It brings in all those powerful, sometimes unruly forces, human emotions, cognitive biases.
And this field, behavioral finance, which tackles this head-on, it's gained serious academic weight. Its insights have been validated with Nobel Prizes, Daniel Kahneman in 2002, Robert Shiller in 2013.
Underscoring just how huge the impact of psychology is on financial economics, on market behavior.
Absolutely.
So our purpose with this deep dive is really to give you a shortcut, a way to understand this documented investor behavior. We want to shed light on those price patterns that just don't quite fit the traditional rational models.
And introduce some of the newer theories that help explain why they happen.
And here's the really critical takeaway for you listening. These predictable errors aren't just academic points. They have a real, tangible financial cost.
They literally cost people money, reduce wealth.
Our goal, then, is to help you understand and maybe even control your own biases, and perhaps even learn to spot and potentially benefit from the biases influencing others out there in the market. Okay, let's start with the basics, the core conflict, really. Traditional finance versus behavioral finance.
Right, so traditional finance, for decades, it built everything on this assumption of rational behavior, basically how people should act to maximize their wealth. Perfectly logical, perfectly calculating.
And that gave us all those elegant theories, right? Arbitrage, portfolio theory, focused on idealized, efficient markets.
Exactly. Very neat. But then behavioral finance comes along and asks, okay, but what about how people actually behave? It pulls in all the messy stuff, emotions, cognitive biases, right into the financial equation.
Yeah.
It's about describing the real world, warts and all.
And when you look at the actual decision-making process, it's way more complex than just plugging numbers into a formula.
Yeah.
Think about it like this. You have the inputs, the facts, the probability estimates. That's the logical part we think we're using. But alongside that, our current mood, how we anticipate feeling about potential outcomes, Those are huge inputs too.
Yeah, that emotional influence, often totally subconscious, it frequently leads us down biased paths.
And what's really wild is that even the logical part of our brain, the bit we think of as being like a computer, even that makes systematic, predictable errors, cognitive errors.
So even without strong emotions obviously swirling around, our decisions can still be predictably off base because of how our brains are wired to process information.
Okay, so this leads us to some key concepts. One of the biggest is prospect theory. We'll dig deeper later, but the core idea is that we value gains and losses differently.
Specifically, the pain of a loss usually feels much stronger, much more acute, than the pleasure of an equivalent gain. Losing $100 hurts more than finding $100 feels good.
Right. And this theory also helps explain why we tend to put investments into separate mental accounts. Like, this money is for retirement, this is for the vacation fund.
Treating each pot of money like it's in its own little bucket.
Exactly. And that partitioning, that separation, actually limits our ability to minimize risk across the entire portfolio. We'll definitely circle back to that.
Now, where do these cognitive errors actually come from? There are a few main sources. First, there's self-deception. We often just believe we're better than we actually are. At driving, at investing, you name it.
Is that always conscious, though?
Not necessarily. It might even be an evolutionary thing. Boosting confidence helped us survive, maybe fool others a bit in social situations.
Interesting. Okay, what else?
Then there's heuristic simplification, basically brain shortcuts. Our brains have limited processing power, memory, attention. So to handle complex stuff quickly, they rely on these mental rules of thumb, heuristics.
And prospect theory is kind of an outcome of that.
Yeah, you could say that. It's the brain trying to save energy. But sometimes the shortcut leads us slightly astray from the optimal path.
And of course, our mood. We touched on that. A bad mood can just override reason. A good mood can make us overly optimistic.
And finally, don't underestimate human interaction and peer effects. The cues we get from others, what they think, how they feel, what they're doing, hugely influence our own choices. We're social animals through and through, even with our money.
So what's the real cost here for your wallet? These biases aren't just interesting quirks. They lead to predictable mistakes that, frankly, make us poorer.
Yeah, they have tangible financial costs.
Take the gambler's fallacy. You see it all the time with lottery numbers.
Oh, yeah. People avoiding numbers that just came up.
Right. Intellectually, we know each number has the same random chance. But people think, oh, 7 hasn't come up in ages, it's due, or 12 just came up but won't come up again soon.
And that's where the insight comes in. If you actually pick the unpopular numbers, the ones that did just come up.
You'd have a better chance of winning.
Not a better chance of winning? No. The odds are the same. But if you do win, you're much less likely to have to share the prize.
Ah, because fewer people pick those recently hit numbers.
Exactly. So your expected payoff is potentially much larger. You might split a jackpot picked by due numbers with hundreds of others, pick the unpopular recent numbers, and you might get it all to yourself.
So understanding that bias lets you position yourself better, not just in lotteries, but anywhere crowd behavior affects the outcome.
Precisely. It's about understanding how these widespread irrational biases shape the landscape.
Okay, let's tackle a big one. Confidence. Or, maybe more accurately, overconfidence.
Psychologists have confirmed this again and again. It causes us to overestimate what we know, underestimate risks, and just exaggerate how much control we think we have.
And it seems particularly prevalent in really difficult tasks, right? Like picking individual stocks.
Absolutely. If you think you're significantly better than the average person at stock picking, well, the data suggests you're probably overconfident.
How does this overconfidence actually show up?
Well, it mainly takes two forms. The first is miscalibration. This is when our sense of probability is just too tight. We think we know things with much more certainty than we actually do.
Like those quizzes where you have to give a 90% confidence range for something.
Exactly. Estimate the weight of a blue whale or the year the Mona Lisa was painted. Within a range you're 90% sure contains the right answer.
And most people get a lot of those wrong, don't they? The ranges are way too narrow.
Dramatically so. Most people miss 5 or more out of 10. It shows just how overcertain we are, even when we clearly lack specific knowledge. Even finance professors fall for this.
Wow. Okay, so that's miscalibration. What's the other form?
The better-than-average effect. That incredibly common, unrealistically positive view we have of ourselves.
Right. Everyone thinks they're an above-average driver.
And an above-average investor. A Gallup-Weber survey back in early 2001 found investors expected the market to return about 10.3% that year,
Okay.
but they expected their own portfolios to return 11.7%. Everyone thinks they'll beat the average. It's almost universal.
And then there's the illusion of control.
Yeah, feeling more confident when we think we have some control, even if we actually don't.
Like betting more on a coin toss before it's flipped.
Exactly. As if your presence or choice could somehow influence a random outcome. In investing, this shows up as believing the stocks you personally own are somehow more likely to do well, just because you picked them, even with no special information. Ownership itself creates this false sense of control.
So how does all this overconfidence translate into actual investor decisions? What are the impacts?
It's kind of a cascade effect.
Yeah.
First, after you have some success in the market, maybe just luck, you fall prey to self-attribution bias.
Meaning?
You attribute the success entirely to your own skill. I'm brilliant.
Instead of maybe just, a rising market.
Precisely. And that success, attributed to skill, just fuels more overconfidence for the next decision. We even see this with professional analysts. Studies show that after a string of successful predictions, they tend to get overconfident and make less accurate, more extreme predictions next time.
Yikes. And the biggest cost is?
Probably excessive trading and risk-taking. Being too certain about your own opinions naturally leads you to trade more often.
And you mentioned research on gender differences here.
Yes, quite stark differences. Men in general tend to be more overconfident in financial matters, and this leads directly to significantly higher trading frequencies. A major study by Barber and Odeen looked at 38,000 households in the 90s. They found single men turned over their portfolios about 85% annually, married men 73%. But married women were down at 53%, and single women at 51%. Huge difference in activity levels.
Wow. And what was the impact on their actual returns? Did all that trading help the men?
That's the crucial part. The same study showed that all the groups, regardless of how much they traded, earned pretty much the same gross returns before costs, around 18.7%.
Okay, so trading more didn't mean higher raw returns.
Exactly. But once you factor in commissions, other trading costs, the net returns tell a very different story. The lowest turnover group netted 18.5%, pretty close to the gross.
And the highest turnover group, the ones trading over 250% a year.
Their net return plummeted to just 11.4%.
That's a massive difference. Over 7% per year just lost to overconfidence.
Lost to overconfidence driving excessive trading. Yeah, think about that over time. $10,000 over 5 years. At 18.5% net, that's over $23,000. At 11.4% net, just over $17,000.
More than $5,000 difference just vanished.
Vanished. And it's not just the transaction costs. Overconfidence also leads people to make poorer choices, selling good stocks too soon, buying ones that underperform.
And this isn't just an individual problem, right? It affects the market overall.
Definitely. You see higher overall trading volume in the market following months where returns were really strong. Why? Because investors collectively get overconfident, think their success was skill, and trade more.
And lower volume after market declines.
Generally, yes. It reinforces that old Wall Street saying, don't confuse brains with the bull market.
Makes sense. Does overconfidence also push people towards riskier investments?
It does. It directly impacts portfolio risk-taking. If you're super confident your stock picks are winners, your perception of risk goes down. This leads to two common issues. One, buying high-risk stocks, often smaller, newer companies, more volatile stuff.
And two,
a big tendency to under-diversify. They concentrate their bets because they're so sure they're right. This loads them up with unnecessary risk.
This sounds related to the illusion of knowledge.
It is. That's the mistaken belief that just getting more information automatically makes our forecasts more accurate and faster than it really does.
Like knowing the last 3 dice rolls were 4s makes you think you can predict the next one better.
Yeah, even though the probability hasn't changed one bit. More information makes us feel more confident, but it doesn't necessarily make us more accurate. There was a cool experiment on predicting college football games. Giving people more info barely budged their accuracy, like from 64% to 66%.
Minimal improvement.
But their confidence in their predictions, that jumped way up from 69% to 79%. The feeling of knowing more outpaced the actual increase in accuracy.
That seems really relevant for novice investors using the internet today. So much information out there.
Exactly. But it's often unfiltered information. Experience helps you filter, synthesize, interpret that data. Less experienced investors relying solely on raw internet info often end up with lower returns. Experience helps turn that raw knowledge into actual wisdom.
Is anyone more prone to this? You mentioned individual versus institutional investors.
Yeah, studies like one in Taiwan showed individual investors definitely exhibit more overconfidence than institutions, especially after market gains. And it consistently leads to worse performance for them. And crucially, these overconfident behaviors are way more pronounced during bull markets.
Like the late 90s tech boom.
Perfect example. You saw investors pile into stocks, choose riskier companies, use more margin debt, all behaviors fueled by the optimism and overconfidence of a rising market. These tend to pull back in bear markets.
What about the rise of online trading itself? Has that made things worse?
The evidence strongly suggests yes. Barber and Odin, again, they looked at investors who switched from traditional brokers to online platforms. Their annual portfolio turnover leaped from 70% to 120% almost immediately. Even 2 years later, it was still elevated at 90%.
Wow. Even in things like 401k, where you wouldn't expect much trading.
Even there, for online users, trading frequency doubled, turnover increased by 50%. And tax loss selling or needing cash quickly aren't really factors in 401ks.
And the bottom line, performance.
They actually underperformed the market after going online. Their average annual returns dropped from 18% to 12%, lagging the market by 3.5% per year.
So the conclusion is pretty stark.
Yeah, the internet with its instant access, perceived control, flood of information, it seems to just pour gasoline on a fire of overconfidence, leading to more trading and, sadly, lower returns.
Okay, let's shift gears a bit and talk about two really powerful emotions that constantly tug at us as investors: pride and regret.
These are huge drivers of behavior. They fuel something called the disposition effect.
Which is?
In simple terms, it's our tendency to sell winning investments too early and hold on to losing investments too long. It's driven by our fear of feeling regret and our desire to feel pride.
That feels very relatable. Imagine you have two stocks. Stock A is up 20%, stock B is down 20%. You need cash. Which do you sell?
The disposition effect predicts you'll sell stock A, the winner.
Why?
Because selling a winner gives you that nice hit of pride. Yes, I made a good call. It validates your decision.
Whereas selling stock B, the loser.
That forces you to confront a bad decision, to realize the loss, and experience the immediate unpleasant sting of regret. We're psychologically wired to seek pride and avoid that pain.
And there's solid research backing this up.
Absolutely. Market studies, like one looking at NYCMEX stocks in the early 80s, consistently found much higher trading volume in stocks that had gone up recently, and lower volume in stocks that had gone down.
Even in December. I mean, you'd think people would be selling losers for tax reasons.
Even in December, the emotional bias avoiding the regret of realizing a loss often trumped the rational tax strategy.
Wow.
And Terence Odin's big study, looking at 10,000 actual investor accounts, he found investors consistently realized, meaning sold, a higher proportion of their gains than their losses. It's also tied up with cognitive dissonance, that discomfort when our actions conflict with our self-image. If an investment goes bad, we might blame our advisor or the market, anything, to reduce that internal feeling of regret for our own decision.
So what's the actual financial cost of this cycle? Selling winners too soon, holding losers too long.
It's significant. Odin's study also looked at what happened after the trades, the winning stocks that people sold. On average, they went on to beat the market by about 2.35% in the following year.
Ouch. And the losers they held on to.
They continued to underperform the market by about negative 1.06% on average.
So it's a double whammy.
Exactly, a double blow to your wealth. First, you potentially pay higher taxes because you're realizing gains more often than harvesting losses. Second, and probably more impactful, you earn lower returns overall because you're cutting your flowers and watering your weeds, essentially, selling future good performers and clinging to future bad performers.
Does anything make this effect stronger or weaker?
Yeah, it seems linked to how personal the regret feels. If a stock drops because of bad news specific to that company, where you might feel some sense of control or responsibility,
the regret feels stronger.
Right, and the disposition effect is more pronounced. But if the stock drops because of broad economic news or a general market crash, something clearly outside your control, the regret is weaker, and you might be more willing to sell the loser. Exactly. The external factor dilutes the personal sting of regret.
And our reference points matter here too, don't they? How we define a gain or loss.
Absolute critical.
Yeah.
It's not absolute. It's always relative to some mental benchmark. For stocks you've held a long time, you might adapt. Maybe the original purchase price isn't the benchmark anymore. Maybe it's the 52-week high or the Dow's all-time high. That becomes the new point from which you measure gain or loss.
This ties back to prospect theory again, right?
Perfectly. Remember how two separate $50 profits feel better than one $100 profit?
Mm-hmm.
That helps explain why we're eager to sell winners quickly. We'll lock in that burst of happiness, feel good, bank the win. But for losers, we resist shifting our reference point down. We don't want to mentally accept the lower price as the new reality, because that would mean implicitly locking in the sadness of the loss.
So we hold on, hoping it gets back to the original price to avoid that pain.
Precisely. Clinging to that hope.
Does this affect whether we'd buy stock again after selling it?
It does, in interesting ways. If you sell a loser, the regret is usually so strong you rarely want to touch it again. Once burned, twice shy, right?
Makes sense.
But if you sell a winner, say it keeps going up after you sell. Your pride turns to regret pretty quickly. But if you sell a winner and then the price falls, now you feel doubly happy. You booked a profit and you timed it perfectly.
So in that second scenario,
You're actually more likely to repurchase that stock later. The positive emotional reinforcement makes you want to engage with it again. It's the emotional narrative driving the decision, not just the price chart.
so the actual advice, the rule of thumb to fight this natural tendency is,
Cut your losses and let your profits run. It goes directly against our ingrained psychology, but it's what behavioral finance strongly suggests is the more profitable strategy long term.
okay, let's talk about risk. But not just risk as a number, but how our perception of risk changes. It's not constant, is it?
Not at all. It's incredibly fluid, heavily influenced by our emotions and recent experiences.
Like the house money effect.
Exactly. After you've had a gain, a windfall, people are demonstrably willing to take more risk. There was a classic experiment. Students who won $15 were much more likely to place a coin toss bet. 77% of them did, compared to only 41% of students who hadn't won anything.
They feel like they're playing with the casino's money, essentially.
Pretty much. You see it at racetracks, too. Gamblers bet more on long shots after they've had a win. The perceived risk just feels lower because it's not their original money anymore.
And the flip side, after a loss.
That often triggers the snakebite effect. People become more risk-averse, less willing to gamble after getting burned.
But wait, there's a twist, right? The trying to break even effect.
Yes, this is the fascinating, often costly paradox. After racking up losses, people might actually take more risk, specifically in a desperate attempt to recoup those losses and get back to even.
Also seen at the racetrack.
Definitely. Gamblers often bet increasingly on long shots late in the day if they're down, chasing that one big score to erase the losses. You see it in game shows like Deal or No Deal, too. Contestants whose expected winnings drop suddenly often become much more likely to take wild, risky gambles.
Trying to claw back what they lost.
Exactly. And it happens with professionals, too. A study on treasury bond traders found that after losing money in the morning, they significantly increased their risk-taking in the afternoon.
Did it work?
Often not. Those aggressive break-even trades frequently led to even bigger losses, digging the hole deeper.
And these individual effects, they scale up, don't they? They can actually influence market cycles.
Hugely. Collective fear after market crash increases risk aversion across the board. Professionals, individuals, everyone allocates less to stocks, pulling capital out, which can actually worsen the downturn.
And the opposite in a bull market.
Right. Widespread optimism decreases risk aversion. People pile more money into stocks, which helps extend the bull run. Our collective emotional state acts like an amplifier for market swings.
Okay, let's switch gears slightly. What about the endowment effect or status quo bias?
Yes. This is the tendency for people to demand much more money to sell something they own than they would be willing to pay to acquire the exact same thing. It's also just a general, often irrational bias towards sticking with what you already have, keeping the status quo.
The coffee mug experiment is the classic example.
That's the one. Give half the students mugs. Those who got mugs demanded about twice the price to sell them compared to what the students without mugs were willing to pay. Result, very few mugs actually changed hands.
And the reason isn't that they suddenly loved the mugs so much.
The core insight is that the pain of giving up the mug they possessed was psychologically stronger than the pleasure they anticipated from acquiring it if they didn't have one. Loss aversion, essentially.
Does this affect experienced traders too?
It does, though maybe less so for very seasoned dealers. Studies at sports card shows found even experienced collectors showed the effect. It's pretty deeply ingrained.
This leads to a really interesting point. How investors perceive risk versus how the industry measures it.
Big disconnect there. The finance industry mostly uses standard deviation, a statistical measure of volatility, as its main gauge of risk.
But that's not really how most people think about risk in their gut, is it?
Not at all. Studies show individual investors focus much more on the probability of losing money and the potential size of that loss. People struggle to even estimate standard deviation in experiments. But their intuitive rating of how risky an investment feels, it correlates strongly with the chance of loss and how bad that loss could be, not with standard deviation.
So the industry's talking one language of risk and investors are feeling another.
Pretty much, which can lead to misunderstandings and mismatches in expectations.
Now let's talk about the mind's defense mechanisms. Cognitive dissonance.
Right. That really uncomfortable feeling you get when your thoughts or beliefs clash. Like your image of yourself as a smart investor bumping up against the hard evidence of a really bad investment decision.
How does that tension affect our actions?
In several ways. First, it can lead to procrastination, avoiding decisions altogether. Like maybe you put off planning seriously for retirement because thinking about your future, possibly less well off. Self creates too much conflict with your current self-image. It's just too uncomfortable to face.
Okay, what else?
Information filtering. We actively ignore or downplay information that contradicts our past choices. Makes it really hard to objectively reevaluate your portfolio and admit you need to change course.
And we might blame others.
Absolutely. Shift the blame to relieve the internal tension. Easier to sell that underperforming mutual fund and blame the manager than to admit your own stock picks are duds and sell those.
This also connects to memory bias, doesn't it? That rosy view of the past.
Yes. We tend to misremember how well our investments actually did, usually thinking they performed much better than they really did. Studies show this across different groups. Architects recall their fund returns over 6% higher than actual. Even members of the AAII, who you'd think are pretty financially savvy, overestimated by 3.4%.
And a German study found online investors overestimated by nearly 12%.
An incredible 11.6%. And interestingly, having more investment experience didn't really reduce this bias significantly. Even in simulated markets, students consistently thought they were beating the market, even when the group average was actually below the market return.
So the need to resolve that cognitive dissonance to feel good about our past decisions, it makes it hard to learn from mistakes.
Extremely hard. Or even to objectively figure out if you need advice. And this bias can feed into bigger market phenomena. It helps rationalize taking more risk after gains, fueling bubbles, and avoiding risk after losses, deepening crashes. Our memory isn't just recording facts, it's recording emotions, and those emotions color the facts.
All right, prepare to be a bit unsettled, maybe, by how easily our choices can be manipulated just by how information is presented. We're talking about framing.
The way a question is asked, the context, it dramatically impacts the decisions we make, often in ways that aren't strictly rational.
The organ donation example is striking, isn't it?
It really is. Countries like the U.S., where you have to actively opt in to be a donor, have participation rates around 25%. But in countries like Austria, where the default is opt out, you're assumed to be a donor unless you actively say no participation jumps to over 90%.
It's the same underlying decision, but the default frame makes a world of difference.
A life or death difference in that case.
Then there's Daniel Kahneman's famous disease outbreak problem.
Classic behavioral economics. Imagine 600 people are expected to die. Program A saves 200 for sure. Program B has a 13 chance of saving all 600, 23 chance of saving no one.
Most people choose Program A, the certain option, right? When it's framed positively as lives saved.
Correct. Risk averse. But now, frame the exact same outcomes negatively. Program C means 400 people will die for sure. Program D means a 13 chance nobody dies, 23 chance all 600 die.
And here, people often switch. They choose the gamble, Program D.
Often, yes. They become risk-seeking to avoid the certainty of 400 deaths. It's the same underlying probabilities, A, C, and B, D, but flipping the frame from lives saved to deaths completely reverses the common preference.
And this isn't just for high-stakes stuff, even simple things.
Even simple math. Ask people to quickly estimate 2 by 3 by 4 dot up to 8 versus 8 by 7 by 6, start down to 2. The estimates can be wildly different, like 4 times different, just because the first number acts as an anchor for their guess.
So how does framing mess with us in investing?
Fundamentally, it impacts how we perceive the most basic principle,
Right.
the risk-return relationship. Higher risk should mean higher expected return.
But people don't always see it that way.
Often not. Financial advisors get it. But surveys of wealthy clients sometimes show they expect riskier firms to have lower returns. It's completely backwards. Even financial professionals, if you ask them about stocks in a general better versus worse frame, instead of explicitly risk versus return,
They might associate better with both high returns and low risks.
exactly, they miss the inherent trade-off because the frame encourages a simpler, less nuanced evaluation.
Framing also affects how we make predictions.
Yeah, subtly. Ask for a price forecast for the Dow Jones. People often predict a slowing or reversal of the trend, like mean reversion, but ask for a return forecast for the same index. They tend to extrapolate the recent trend, assuming what just happened will keep happening.
Same market, different question frame, different mental bias kicks in.
Precisely. Representativeness bias in the second case.
This ties into Kahneman's idea of two thinking modes, doesn't it?
Yes, his System 1 and System 2 thinking, essentially. There's the analytical reasoning mode, slow, deliberate, effortful, like calculating 17 times 258.
System.
Right. And then there's the intuitive mode, fast, automatic, effortless, often emotional, like instantly recoiling from chocolate, shaped like a cockroach.
System 1. And most of our judgments are.
Kahneman argues most are intuitive, System 1. It handles the bulk of our daily processing.
Like driving a familiar route while chatting, that's intuitive.
Mostly, yeah. But if you suddenly need to navigate a complex detour or parallel park in a tight spot, you need to switch to analytical, System 2. It requires focused attention.
And investment decisions often need that analytical thinking.
They really do. They're often abstract, complex, require careful calculation. But our intuitive System 1 is always trying to jump in and take shortcuts, especially under pressure or uncertainty.
How do researchers measure which mode someone tends to use?
One tool, the cognitive reflection test, CRT. It's just a few tricky questions designed to lure you into an intuitive wrong answer unless you stop, engage analytical thinking, and override the impulse.
Like the bat and ball problem.
That's one of them. Scores on the CRT give an indication of whether someone leans more towards intuitive or analytical thinking. MIT students tend to score higher, more analytical.
And does this thinking style interact with framing?
It does. An experiment with financial planners used the CRT. In a positive gain frame, the intuitive thinkers tended to choose the certain smaller gain. The analytical thinkers were more likely to go for the risky gamble with the higher expected value.
Okay, different choices based on thinking style. What about in a loss frame?
Here, interestingly, both groups often switched. The analytical thinkers often chose the certain smaller loss to cap the damage. But the intuitive thinkers sometimes became risk-seeking, choosing the gamble for a chance to break even and avoid the certain loss entirely.
So the same frame hits people differently depending on their cognitive style.
Exactly. It's not one size fits all.
How does this play out in real-world financial decisions, like pensions?
Big time. In 401ks, people often show extremeness aversion. If they're unsure about risk, they don't pick the mathematically best option. They pick the one that feels like it's in the middle, the moderate choice, which might be totally wrong for their actual needs.
And the opt-in versus opt-out design we mentioned.
Huge impact on 401ks. Opt-in plans often have really low participation. Switch to opt-out, making enrollment the default, and participation skyrockets. It leverages our inertia, our status quo bias, for a good outcome.
Even payday loans. How does framing work there?
They typically frame the cost very narrowly. $15 per $100 borrowed. Sounds small, manageable. But if you reframe that same cost as an annual percentage rate, an APR, which is often astronomical, or show the total cost over months, it suddenly looks much worse. That broader, more transparent framing actually reduces repeat borrowing significantly.
What about claiming Social Security? A massive decision for many.
Framing is crucial there too. The old way often focused on a break-even analysis. How long do you have to live to make up for delaying benefits? It framed delaying in terms of potential loss if you die early.
Which pushed people to claim early.
Exactly. Often about 16 months earlier than might be optimal. But later research found people claim later, which is often financially better when you frame it differently. Use an older reference age, talk about the gains from waiting, frame it in terms of consumption, how much annual income it provides. Small framing shifts lead to huge differences in lifetime income.
So the big takeaway here is,
people are easily fooled by frames. Actively work to reframe information for yourself. Look at the bigger picture. The long-term implications, the total costs, the alternative perspectives. It's a powerful way to make more rational and likely more profitable decisions.
Okay, let's dig into how our brains organize money. It's not always logical. We're talking about mental accounting.
Right. Think of it like your brain has this internal filing system for money. Each decision, each source of funds, each goal gets its own little mental folder or bucket.
And we don't like mixing the buckets.
We really don't, even if it makes perfect financial sense. The classic example is Mr. and Mrs. J. They had, say, $15,000 in a money market account, earning maybe 4%, saved up for a future vacation home. That's the vacation home bucket.
Okay.
At the same time, they took out an $11,000 car loan at 9% interest. That's the new car bucket.
They're losing money on the difference in interest rates.
Clearly. They could have just paid off the car from their savings and saved themselves over $1,000 in interest. But psychologically, they couldn't bring themselves to dip into the vacation home money to pay for the car. The mental buckets were too rigid.
Even though money is fungible, a dollar is a dollar.
Logically, yes. But we put labels on it. Dirty money, easy money, emergency fund, fun money. Think about gift cards. People often use them for treats or splurges they wouldn't normally buy with their regular money, even though it's all just purchasing power. It's mentally earmarked as different.
This extends to budgeting too, right? Mental budgeting.
Definitely. We try to match the timing of the emotional pain of costs with the emotional joy of benefits, like buying a washing machine. Long-term benefit. People often prefer to pay for it over time, spreading the cost to match the ongoing use.
But a vacation, short-term benefit.
A lot of people, maybe 60%, actually prefer to prepay.
Why?
Because the anticipation is fun. And prepaying means you enjoy the trip without the dread of getting a big bill afterwards, which would sour the happy memories. You decouple the pain of paying from the pleasure of consuming.
Interesting. Same reason people prefer getting paid after doing overtime work.
Yeah, it feels weird to get paid up front for work you haven't done yet. It's like taking on debt for a future benefit, which feels off. We like matching the loan length to how long we'll consume something lasts. Long loans for houses, shorter for cars, very short or none for vacations.
What about the sunk cost effect, ignoring past costs?
Well, traditional economics says we should ignore sunk costs, money already spent that you can't get back. It shouldn't affect future decisions.
But we don't, do we?
We really don't. We have this greater tendency to continue an endeavor once an investment has been made. We hate closing a mental account with a loss.
Does the size of the sunk cost matter?
It does. Imagine you bought $40 basketball tickets. It starts snowing heavily. You're much more likely to brave the storm and go than if the tickets were free.
Because you don't want to waste the $40.
Exactly. You want to avoid the psychological pain of closing that basketball ticket mental account without getting the benefit.
Does when you spent the money matter?
Yes. Timing is the other dimension. You're even more likely to go to that snowy game if you bought the tickets yesterday versus a year ago. The pain of the sunk cost fades over time.
So this mental accounting has real economic impact.
Absolutely. People make choices that cost them more money just to satisfy these mental accounting rules.
Right.
Like MBA students choosing a 3-year 12% interest loan for remodeling over a 15-year 11% loan they could prepay. The 11% loan was cheaper.
But they wanted to match the loan term to the remodel's perceived life.
Yes. Willing to pay more for the mental budgeting comfort. It highlights a self-control problem, too.
And saving windfalls versus regular income.
Much easier psychologically to save a bonus or tax refund. That goes into the wealth bucket. Paychecks often go straight into the consumption bucket. It helps explain why so many Americans overpay their taxes. They like getting that big refund check, which feels easier to save than trying to save small amounts from each paycheck.
And why people often wait until the April 15th deadline to contribute to their IRAs.
Yep. We need that external deadline to force the self-control to move money into the savings bucket.
Okay, so if our mental accounting is often irrational, can money actually make us happy? The book suggests yes, if we spend it right.
It does. It offers some really neat research-backed ways to get more happiness, bang for your buck.
Like buying experiences over things.
Right. Material stuff. We adapt to it quickly. The novelty wears off. But experiences, travel, concerts, learning a skill that can be relived in memory, providing lasting joy.
And buying many small things instead of a few big ones.
Yeah, that can expect a prospect theory. Multiple small gains feel better than one large gain. So frequent small treats might bring more cumulative happiness than one big splurge.
What about paying now to consume later?
That boosts happiness too. Prepaying for something, like that vacation, builds anticipation, which is itself pleasurable. Buy now, pay later. Does the opposite? The lingering bill tarnishes the memory.
And helping others.
A big one. Spending money on gifts or charity consistently boosts well-being. It strengthens social bonds and just feels good, especially if it's local and you can see the impact.
How does mental accounting specifically mess with investing?
Well, it definitely worsens the disposition effect we talked about. For example, an investor might deliberately sell several losing stocks all on the same day. Why? To bundle the pain, aggregate the losses in one mental transaction, minimize the regret felt for each individual loss.
And for winners.
They might do the opposite. Sell winning stocks on different days to spread out the pleasure. Savor each gain separately. Maximize the positive feeling.
And for asset allocation, building the portfolio itself.
Mental accounting leads us to treat investments in isolation. We put them in separate mental buckets, the 401k, the brokerage account, the kids' college fund, and overlook how they interact.
Which leads to poor diversification.
Often, yes. You see those 401k studies with tons of people having either no stocks or all stocks, or people not considering their company match when choosing their own allocation, leading to massive overweighting in company stock. This separate account syndrome is rampant. Investors evaluate each potential investment on its own merits, ignoring how it fits, how it correlates with everything else they already own. And that completely undermines the power of diversification.
So, building on that mental accounting idea, let's look specifically at how we form portfolios. How do these mental buckets affect the actual construction?
Well, as we said, mental accounting makes us discount the interaction between investments. Imagine you have two stocks, A and B. Maybe they have similar returns, similar volatility on their own, but crucially, their prices move in opposite directions. One goes up and the other goes down.
So combining them would smooth things out, reduce overall risk.
Dramatically. That's the whole point of diversification. But mental accounting makes it hard to see that benefit. You're instinctively focused on stock A in its bucket, stock B in its bucket, not the combined effect.
This leads to what the book calls Buffett-style investing.
Yeah, but not Warren Buffett style. More like loading up your plate at a food buffet. Ooh, that looks good. I'll have some of that. And some of that. Decisions are made investment by investment based on individual appeal, often completely ignoring correlations how they move relative to each other. The key tool for diversification gets missed.
So people end up with a collection of assets rather than a strategically constructed portfolio.
Pretty much, which leads to the idea of building behavioral portfolios, often shown as a pyramid. Schefrin and Statman developed this model. Investors mentally create layers in their portfolio for different goals. Maybe a safety layer at the bottom, low risk. Then maybe an income layer. And a speculative get-rich layer at the top.
And they pick investments for each layer's goal.
Exactly. Investments are selected to fit the mental account of that layer, not necessarily to optimize the overall portfolio's risk and return. The result is diversification by goal, which isn't the same as purposeful asset diversification based on correlations. It often leads to inefficient portfolios taking more risk than necessary for the potential return.
What about naive diversification, the one rule?
Yes. The basic idea, don't put all your eggs in one basket, is sound. But without clear guidance, people often just default to dividing their money evenly among whatever options are available. The one heuristic.
Like in a 401k, if there are 5 funds, people put 20% in each.
Often, yes. Or look at the TWA pilots example. They were offered 5 stock funds and 1 bond fund. They ended up allocating about 75% to stocks. Compare that to University of California employees offered 1 stock fund and 4 bond funds. They allocated only 34% to stocks. The menu of options drove the allocation, not necessarily a rational assessment of risk tolerance.
People might even filter options first.
Right, the conditional one heuristic. Maybe eliminate a few choices they don't like, then divide evenly among the remaining acceptable ones, even if those aren't the best for diversification.
And company stock fits into this mental accounting picture, too.
Big time. It's often the most familiar investment, so it gets its own mental account, often perceived as safer than it is. Despite disasters like Enron, studies still show huge allocations, sometimes over 50% of 401k assets, are tied up in the stock of the company people work for.
Which is incredibly risky, given their job is already tied to that company.
Exactly. It's a massive failure of diversification, driven by mental accounting and familiarity bias.
Let's dive into 2 more powerful biases: how stereotypes and simple familiarity shape our investment views. First, representativeness.
Right. This is our brain's tendency to judge situations based on how closely they match a stereotype or a typical example we have in mind. We assume similar qualities mean things are alike.
The Mary the librarian example illustrates this well.
Perfectly. Describe Mary. Quiet, studious, cares about social issues, studied English at Berkeley. Then ask, Is she more likely a librarian and a Sierra Club member, or someone in banking? Most people pick librarian and Sierra Club member because it represents the description so well.
Even though adding the Sierra Club part makes it statistically less probable than just librarian, and both are way less probable than banking just based on population numbers.
Exactly. We go with the representative description over the base rate probabilities.
How does this play out in investing?
Leads directly to the good company's good investments fallacy. We see a company with a great track record, consistent past earnings growth, and we assume that's representative of what will happen in the future. We expect the strong past performance to continue.
Which leads to overpaying for these glamour stocks.
Precisely. Investors overreact to past success, bid the price up too high. Studies consistently show that value stocks, companies, maybe with lower past growth, but trading at cheaper valuations, actually tend to outperform these glamour stocks over time.
Like the LSV study found, value beat glamour significantly.
Significantly, yes, over 1 and 5 years. Good companies don't always make good investments because the market, driven by representativeness, often prices that pass goodness in and then some.
So we're extrapolating the past too readily?
We are. Believing the recent past is the best guide to the future. Even financial experts do this. Their forecasts for future market returns tend to drop after market declines, yet they might still say they believe in long-term mean reversion. It's contradictory. Their short-term estimate follows the recent trend.
Okay, let's switch to familiarity bias, simply preferring what we know.
A huge one in investing. Look at home bias. Investors massively overweight stocks from their own country.
Way more than global market cap would suggest.
Far more. U.S. investors hold maybe 87% U.S. stocks, even though the U.S. is only about 43% of the world market. Japan, 91% domestic. UK, 72%. It's as if we perceive foreign stocks as 2 to 5 times riskier than they actually are, just because they're less familiar. This leads to poor global diversification.
Even within their home country, right? The baby bells example?
Yeah. After the AT&T breakup, people were way more likely to own shares in their local Baby Bell, the one they saw the trucks for, the name they knew. Pure familiarity.
And when people do invest internationally,
they often show a foreign bias towards countries that are geographically close or culturally similar. German funds might overinvest in France, but underinvest in Japan, missing out on diversification benefits.
Then there's local bias, investing in companies nearby.
Right, the Coca-Cola example. Georgia residents, especially in Atlanta near HQ, own a disproportionate amount of Coke stock. On average, U.S. households have about 30% of their portfolio in companies headquartered within 250 miles. Even professional money managers buy stocks from companies that are, on average, 100 miles closer to their own office.
It's subconscious, but it's there. What about something as simple as the company's name?
Amazingly, yes. What's in a name? Turns out, quite a lot for stocks. Research found that company names that are more fluent, easier to pronounce, maybe more English-sounding, tend to have broader ownership, higher trading volume, and even higher valuations.
Like BUD or LUV or YUMM versus less catchy tickers.
Exactly. Even mutual funds with managers who have non-foreign sounding names tend to attract more assets. That subtle feeling of familiarity impacts choices.
So the bottom line is, familiarity breeds investment problems.
Often, yes. The most familiar investment is usually your employer's stock, which explains the dangerous overconcentration in 401ks. We talked about 42% of assets in some surveys.
And familiarity creates this distorted perception of risk.
We mistakenly think familiar things are safer and will give better returns. People holding company stock overwhelmingly thought it was less risky than a diversified market fund, which is just financially incorrect.
So familiarity drives excessive allocation to employer stock, local stocks, domestic stocks,
leading directly to a lack of proper diversification and ultimately higher risk for the investor.
We can't ignore the social dimension. We're social creatures, and that deeply affects our investing, often unconsciously. Let's talk social interaction and investing.
Yeah, the whole culture around investment talk has shifted dramatically. It used to be pretty private, almost taboo.
Now it's everywhere. CNBC in bars, radio shows, coworkers chatting about stocks at lunch.
Exactly. And this constant chatter has a real impact on how information spreads and how we form opinions. Did you know over half of investor interest in a specific stock actually starts because someone else mentioned it to them?
Wow. Not from research, it's from conversation.
Often, yes. This leads to second-order beliefs. Our opinions aren't just based on facts. They're heavily shaped by what we think other people think about the market.
And we assume others think like us. The false consensus bias.
Right. We tend to overestimate how common our own beliefs actually are.
This creates that imitate thy neighbor's portfolio effect.
It really does. Studies show that households that are more socially active, interact with neighbors involved in church or clubs, are more likely to invest in the stock market in the first place. There's even a direct neighborhood effect. If your neighbor buys 10% more stock in a certain industry, you're likely to increase your holdings in that same industry by about 2%, even stronger for local companies.
Even professionals aren't immune. Shared backgrounds influence holdings.
Seems so. Managers with shared ethnic backgrounds tend to hold more similar portfolios. The social connection matters.
And social media is the new town square for this.
Absolutely. The new talk. A big German study looked at hundreds of thousands of stock-related tweets. They found positive sentiment in tweets correlated with positive returns. More tweet volume linked to higher trading volume. More disagreement in tweets linked to more market volatility.
And good advice gets amplified.
Yeah, tweets with better-than-average advice tended to get more retweets, attract more followers. It's a whole new ecosystem shaping market dynamics.
Our immediate social environment matters too. Workplaces, communities.
They develop investment norms. Like those librarians, 401k participation rates varied significantly depending on the social norms of their specific library location, not just individual choice.
What about investment clubs? Formalizing the social aspect.
They had a boom, peaking around 2000, but have declined a lot since. And despite the myth of clubs beating the market, studies looking at their actual holdings found they generally underperformed the S&P 500 significantly.
Why?
It came down to social dynamics. Clubs that were disciplined, use rigorous analysis, like the Klondike Club example, tended to do better because they actively managed biases. But more informal clubs, driven by hot tips, gossip, emotion, like the California Investors Club, performed poorly because the social setting just amplified the psychological biases.
And the media's role in all this.
Often it just makes things worse. Focuses on stories, drama, personalities over careful analysis. Like that Wall Street Journal column, its tone could cause temporary price swings and high trading volume, but didn't provide lasting info.
Individuals react to stale news, chase past winners.
All the time. Media coverage often fuels that representativeness bias, getting people to pile into mutual funds after they've had a great run.
The language used matters too. The hype.
Definitely. Vivid emotional words grab attention, especially for investors who might be on the fence or going against the crowd. Think about Jim Cramer's Mad Money, pure showmanship. His recommendations caused these dramatic, short-term price pops.
Like 2.5% overnight?
Sometimes, yeah. But the returns usually vanish quickly. It's the spectacle, the hype, not new information or real predictive power.
All these social pressures can lead to herding, right? Everyone doing the same thing.
Exactly. Acting on social consensus, which just magnifies everyone's biases. Misery loves company. If your stock pick tanks, but everyone else bought it too, the regret feels a bit less painful.
The dot-com bubble is the poster child for this.
Absolutely.
Yep.
Insane valuations. Yahoo at a PE of 1,300, eBay at 3,300. That means it would take literally thousands of years of earnings to justify the stock price. Remember eToys? $30 million in sales, losing money, yet valued at $8 billion. While Toys R Us, making hundreds of millions in profit, was valued at only $6 billion. Pure herd mentality, zero logic.
People get fooled by superficial things, like fund names changing, cute ticker symbols.
Yes. Funds change names to sound hot, attract money, even if nothing else changes. Catchy tickers like BUD or LUV are linked to higher valuations than boring ones.
This herd behavior drives a short-term focus.
Totally. Investing based on where the price might go next week or tomorrow. Like that person investing her life savings in AMLN because it was supposed to double by August without even knowing company name.
That's pure faith versus due diligence.
And the things are different this time. Rationalization you always hear during bubbles. The popular investment talk just feeds this herd behavior.
Underneath so much of this is emotion in investment decisions.
It's central. Traditional finance wanted to believe reason wins out. Behavioral finance shows feelings often dominate.
The dominance of effect. Even unrelated feelings matter.
Definitely. Good mood from sunshine, bad mood from your team losing. It can spill over and color your financial judgment. Emotions aren't separate from thinking. They're deeply integrated. Antonio Damasio's work with brain-damaged patients showed this. People who lost the capacity for emotion, even if intellectually fine, couldn't make rational decisions. Emotion is necessary.
Our mood directly affects our outlook. Pessimism versus optimism.
Clearly, bad mood. You see higher chances of bad things happening, lower chances of good. Good mood, the opposite. A sunny day literally makes you more optimistic about everything, including the market.
We also become insensitive to probabilities when emotions are strong.
Yeah, if a gamble feels really exciting or scary, we might treat a 1 in 10 million chance almost the same as a 1 in 10,000 chance. The feeling overrides the math.
And misattribution bias, blaming our mood on the market.
Right. Feeling good. Wow, the market looks promising today. Feeling bad. Ugh, everything looks risky. We misattribute the source of our feeling onto the financial decision. Good mood often leads to more risk-taking.
The sunshine effect is real then. Sunny days is better market returns.
The data is surprisingly consistent. Server tips are higher on sunny days. Stock markets globally show statistically significant better performance on sunny days compared to gloomy ones.
New York, 15% higher annually. London, 22%.
That's what some studies found. Even institutional investors seem affected more critical on cloudy days, more likely to buy on sunny days. Good weather seems to boost mood and risk appetite without actually making people smarter.
What about seasonal affective disorder, SAD?
That fits too. Less daylight in fall-winter can lead to depression for some, which correlates with lower risk-taking and lower stock returns, especially in places farther from the equator with bigger light shifts.
Negative emotions have an impact too. Lunar cycles, sports losses.
Seems so. Some studies link lower stock returns to the full moon phase. Big international sports losses have been correlated with negative social outcomes like heart attacks and crime spikes. A loss feels like a deviation from the expected norm, causing emotional turmoil.
And optimism. It's generally good, but can skew financial decisions.
Very much so. Optimism can lead us to ignore risks, like smokers thinking they won't get cancer. In markets, optimists are often the ones bidding up prices of uncertain speculative stocks. Pessimists just sit out.
But the Palm 3Com example really highlights that crazy optimism.
Perfect case. Palm, the subsidiary, was trading for way more per share than its parent company 3Com, even though 3Com owned 1.5 shares of Palm plus all its other businesses. Logically impossible, purely driven by irrational optimism about Palm. This rampant optimism is what fuels Bubble's tulipmania.coms. Always with new era rationalizations.
What about overall market sentiment, the general mood?
That ebbs and flows too. Sometimes society is generally optimistic, sometimes pessimistic. Things like the Ramadan effect, significantly higher returns in Muslim countries during Ramadan, seem linked to heightened optimism then. Researchers use proxies like closed-end fund discounts or IPO volume to measure sentiment. Low sentiment often predicts higher future returns, especially for those speculative stocks, because pessimism had pushed their prices down too far.
Finally, some people just enjoy the thrills of investing, like gambling.
Absolutely. Trading can provide that sensation-seeking rush. The demographics of people who play lotteries frequently overlap quite a bit with those drawn to high-risk, lottery-type stocks. And people who exhibit sensation-seeking elsewhere speeding tickets, poker also tend to trade more frequently.
Okay, we've looked outward at social factors, inward at emotions. Now let's focus on the internal battle, self-control and decision-making.
This is often framed as a conflict between two selves, the planner and the doer. The planner is rational, focused on long-term goals. The doer is impulsive, wants immediate gratification.
And the doer often wins in the short term.
Very often. We have a strong bias towards immediate rewards and procrastinating unpleasant tasks. Like the example, faced with a 7-hour unpleasant task next month versus an 8-hour one in 6 weeks. Looking ahead, you pick the shorter, earlier one.
But when next month actually arrives,
You suddenly prefer to push it off to 6 weeks, even though it's more work. The short-term desire to avoid the unpleasantness overrides the long-term logic. Hyperbolic discounting.
so we invent rules of thumb to help the planner win.
Exactly. These are coping mechanisms. Fight the urge to splurge. Never touch the principal. Buy low, sell high. We create these rules when we're calm and rational to guide us when emotions flare up.
We're even willing to pay for self-control.
We are. Athletes hiring agents to limit their spending. Smokers buying expensive single packs instead of cheaper cartons to control consumption. We recognize our weakness and sometimes pay to outsource or constrain our willpower.
Saving for retirement is a classic self-control challenge.
Huge challenge, which is why, as we discussed, lump sums like bonuses or tax refunds feel easier to save. They bypass the regular consumption mental account.
Explains the overpaid taxes and last-minute IRA contributions.
Precisely. And 401k. The sheer number of choices can paralyze people into procrastination. Importance plus complexity equals inaction. That's why automatic enrollment is so powerful.
What about the preference for cash dividends over homemade dividends? Is that self-control related?
Often, yes. Rationally, selling a few shares to create your own dividend might be more tax efficient. but the never touch the principal rule, a self-control rule, especially for retirees, prevents people from doing that, even if it means less after-tax income. They see selling shares as violating their self-imposed rule.
So how can we actively try to beat these biases? What are the strategies?
First and foremost, understand the biases. Awareness is step one. Just knowing these tendencies exist helps you spot them in yourself.
Okay.
Know why you are investing. Have specific, measurable goals. Not just get rich, but I need $6 per year for Y purpose in Z years. This long-term focus anchors you, helps you monitor progress, and overrides short-term noise.
Have quantitative investment criteria.
Crucial. Objective rules for buying and selling. Avoid decisions based on emotion, hype, stories. Remember the disciplined Klondike Club versus the emotional California Club. Rules beat feelings.
I diversify properly.
Yes. Not just lots of stocks, but different types, industries, sizes, geographies. Use diversified funds. Avoid company stock. Include bonds. True diversification.
Control your investing environment.
Manage your inputs. Check stocks maybe monthly, not daily. Dampens the emotional reactions. Maybe trade only once a month on a set day. Fights overconfidence and the illusion that speed matters. Review the whole portfolio, maybe annually.
Any other rules of thumb?
Yeah, avoid penny stocks. Treat chat rooms purely as entertainment. Watch out for advisor conflicts of interest. And maybe review this list of biases once a year to keep them top of mind.
Does this mean we all need a financial advisor?
It's complicated. Advisors can help, but they're human too, subject to the same biases. And their fees can create conflicts. Plus, people often don't value or follow good advice, even when it's free and unbiased. Remember that German study? Only 1.5% actually followed the optimized advice, even though it performed better.
So maybe the system needs to be designed better? Choice architecture.
That's a really promising area. Designing systems that use our biases for good, nudging us towards better outcomes.
Automatic enrollment in 401k is a key example.
Perfect example. Boost participation massively by leveraging inertia. The downside is people often stick with the default, often conservative option due to that same status quo bias.
What about the Save More Tomorrow SMT plan?
Brilliant. Designed by Thaler and Bernarzi, it beats procrastination and status quo bias beautifully. You agree now to increase your savings rate, but it only starts with your next pay raise. Then it increases automatically with future raises. It feels painless because it's future money, and you can opt out anytime.
And it worked.
Dramatically. In the test, the SMT group nearly quadrupled their savings rate compared to the control group.
Other examples. Savings lotteries. Social influence.
Yeah, save and win adds excitement, and social pressure works. Public savings goals led to huge increases for Chilean entrepreneurs. Coworker influence drove pension choices in Israel more than fund quality. Our social context is a powerful lever.
We've covered psychology, emotion, social factors, but we need to go even deeper, right down to our biology. Physiology of investing.
Yes, our actual physical makeup influences financial choices. Take gender. On average, women tend to be more risk-averse than men financially, socially, physically. This often leads to lower-risk investment portfolios for women, which, over the long term, can contribute to a gender wealth gap, if lower risk also means significantly lower returns.
Is that purely biological, nature versus nurture?
It seems to be a mix. That study comparing girls at all-female versus co-ed schools was revealing. Girls at the all-female schools took more financial risk, closing about half the typical gender gap. It suggests the social environment plays a big role in shaping risk tolerance. It's not just innate biology.
Which brings us to the broader nature versus nurture debate for financial behavior.
Twin studies are key here. Comparing identical twins, shared genes, to fraternal twins, shared environment, fewer shared genes in Sweden. They found genetics explains maybe about a third of differences in things like stock market participation, how much is invested, risk levels, especially for younger people.
So genetics matters, but it's not everything.
Not at all. Shared childhood environment explained very little. Unique adult experiences seem to explain the other two-thirds. Adoption studies confirm this too. Comparing adoptees to both biological and adoptive parents shows both genetics and environment matter. But environment seems to have a 2 to 4 times larger impact on participation and risk levels.
So genes set predispositions, but environment and experience shape the outcome more.
That seems to be the current understanding, yes.
What about physiology's direct impact? Hormones.
Testosterone is a big one. Higher levels are associated with riskier behavior. You can even see correlations with prenatal exposure via the 2D.4D finger ratio index finger. Shorter than ring finger suggests higher prenatal T, linked to more financial risk later. Even CEO facial masculinity has been linked to things like misreporting.
And active testosterone levels.
Yeah, professional traders in London with higher morning testosterone levels tended to have higher daily profits. In lab tasks, higher T subjects took more risks.
And financial decisions affect our bodies too, vital signs.
Definitely. High market volatility triggers measurable stress responses in traders, higher blood pressure, skin temperature changes, more pronounced in newer traders, but present even in experienced ones.
Then there's genoeconomics, linking specific genes to economic behavior.
It's an emerging field, but challenging. The genome is vast. Risk of finding spurious correlations is high. But they're looking at specific genes, like variations in dopamine receptors, like the DRD4 gene. Certain variants are linked to needing more stimulation for reward, which correlates with novelty-seeking, gambling, less saving, more debt. It suggests a biological underpinning for some financial impatience or risk-seeking.
Finally, what about cognitive aging?
A significant factor. People generally become more risk-averse as they age, especially after 70.
Why is that?
About 85% of that increased risk aversion seems due to declines in cognitive abilities, especially math skills.
And that impacts investment outcomes.
It does. Associated with poorer stock selection, weaker diversification skills, and ultimately 3–5% lower risk-adjusted annual returns, particularly noticeable after age 70. Our changing physiology with age directly impacts financial capability.
Wow. Okay, we have covered an immense amount of ground today. It really shows just how complex our financial lives truly are.
It really does. I think what's crystal clear is that investing isn't just some abstract mathematical exercise. It's deeply, deeply intertwined with our psychology, our biases, our emotions, even our biology.
And understanding these forces, these often hidden currents running beneath the surface of our own minds and the market, that's the absolutely critical first step, isn't it?
Yeah, it's everything. It's the starting point for making more informed, less biased decisions, and ultimately for building greater wealth and achieving that long-term financial well-being. You have to become aware of the invisible forces first.
So a final thought for you, our listener, to take away and ponder. Think about a significant financial decision you've made in the last year or so. A big investment, maybe, or a savings choice, how you handled some debt. Now, with all these ideas we've discussed, overconfidence, regret aversion, framing, mental buckets, maybe even just your mood that day or who you talk to.
Right.
How might you uncover the real psychological drivers behind that choice? Going beyond just the logical pros and cons you probably listed at the time, what was really pushing you?
Or, flipping that around, knowing what we now know about these inherent biases we all share, how can we push for better systems? How can we as individuals or as a society advocate for or maybe even help design financial products or systems that use choice architecture to nudge us towards better long-term financial health?
Yeah, things like better automated savings, clear communication from banks, maybe even just building in pauses before big decisions. What changes could you make or encourage to build a more bias-resilient financial future for yourself and maybe for others too? Thank you for joining us on The Deep Dive.
Thanks, everyone.
Until next time, keep digging.